Today, we're talking about the 5 biggest financial mistakes to avoid in your 20s and 30s. These are common mistakes that many people make, but with a little knowledge and discipline you can avoid them. Hello, welcome to our channel. Now let's look at common financial mistakes. Mistake number 1, not having a budget. The first and biggest mistake many people make is not having a budget. A budget is a plan for your expenses that takes into account your income and expenses. Without a budget, it's easy to overspend and end up in debt. If you're not sure how to create a budget, there are many online resources that can help you get started. We covered it in the previous video. The key is to be honest with yourself about your spending habits and stick to your budget as much as possible. Mistake number 2, not saving enough. The second mistake is not saving enough. It's important to start saving as early as possible, even if it's just a small amount each month. The sooner you start, the more time you'll have for your money to grow. Ideally, you should save at least 20% of your income every month, but if that's not possible, try to save as much as you can. It is important to have an emergency fund to help you prepare for unexpected expenses. Financial experts generally recommend saving enough money to cover 3 to 6 months of living expenses in case of job loss or other emergency. It may seem daunting, but even putting aside small amounts each month can help you grow your savings over time. Mistake number 3, accumulating too much debt. The third mistake is accumulating too much debt. This can easily happen if you are not careful with your spending. Credit card debt, in particular, can be a slippery slope. It's important to only use credit cards for purchases that you can pay off in full each month. If you have debt, focus on paying it off as quickly as possible to avoid interest charges and other costs. A good strategy is to pay off the debt with the highest interest rate first, as this will save you the most money in the long run. If you have a high interest rate loan, you should also look into refinancing options. Consider transferring your balance to a credit card with a lower interest rate or consolidating multiple loans onto one card. Mistake number 4, not investing. The fourth mistake is not investing. Many people think that investing is something that only rich people do, but that is not true. Investing is a way to grow your money over time and can help you reach your financial goals faster. If you start investing $200 a month in your 20s, you could have over $500,000 in the bank by the time you reach retirement age. That's a significant amount that can make a difference in a comfortable retirement. There are many different types of investments, including stocks, bonds, mutual funds, and real estate. Additionally, when considering how to invest your money, it's important to consider the type of return you can get from the investment. With an emergency fund, you don't need to worry about falling behind. You just need to make sure you have access to funds in case of an emergency. You may want to open a high-yield savings account or invest in a low-risk money market fund so that your emergency fund is readily available when needed. It's important to do your research and find investments that are right for you. Mistake number 5, not planning for the future. The fifth and last mistake is not planning for the future. It is important to think about your long-term goals and how to achieve them. This includes things like saving for retirement, buying a home, and starting a family. By planning ahead, you can make sure you're on track to reach your goals and avoid any financial surprises along the way. These are 5 financial mistakes to avoid in your 20s and 30s. By having a budget, saving enough, avoiding debt, investing and planning for the future, you can succeed. Thank you for staying with us until the end of the video. Good luck.